We are diving deep today into, well, one of the biggest questions hanging over the economy right now, the AI boom.
Yeah.
Are we watching a genuine tech revolution, maybe the biggest ever, or are we just inflating another massive bubble, kind of like 2000 all over again?
That really is the crux of it, isn't it? And our mission today really is to unpack that tension because you look at the material and the arguments on both sides are, frankly, incredibly strong.
Yeah, you've got this feeling of like amazing potential on one hand.
Right, a total revolution. But then you also have these pretty stark warnings, people talking about an abrupt and sudden collapse. And that comparison to the dot-com crash just keeps coming up.
And the money involved is just staggering. It makes it feel so high stakes. I mean, think about this. Since late 2022, when that big generative AI tool launched, the U.S. stock market's value shot up by something like $21 trillion.
21 trillion. It's almost hard to grasp.
It's like the entire economy of a major country just added on top, largely fueled by this AI excitement. And that scale, it's causing real nervousness.
Oh, absolutely. And it's not just jittery investors. I mean,
Yeah.
when you hear actual founders, key people inside the AI industry voicing serious concerns about massive losses.
Right.
And then you have major international bodies stepping in, the IMF, the Bank of England explicitly warning about a dot-com style bubble. Well, you've got to take that seriously. They're flagging a real risk here.
Okay, so let's dig into those similarities first. Why does this whole situation feel so much like the run-up to the year 2000 for so many people? What are those specific echoes?
Well, the most obvious thing is you have these two periods, late 90s and now, both just completely energized by a belief in a kind of magic word. Back then it was internet, now it's AI.
And the promise is the same, right? It'll change everything, make everyone rich super fast.
Exactly. And you saw companies in the late 90s going public, getting these huge valuations based on almost nothing, just an idea, maybe a website plan, and that crucial .com at the end of their name. Often no real products, certainly no profit.
And today, the anxiety's there too.
You can see it online. The sources mention the sheer volume of people searching for terms like AI bubble. That tells you there's this underlying hum of anxiety, this worry that the hype might be outpacing reality, just like back then.
Let's talk numbers, though, market structure.
Yeah.
Because that's where some parallels get kind of chilling.
They really do. Okay, look at the S&P 500. Right now, the tech sector makes up about 32% of the total market value.
Okay.
In March 2000, right at the peak before the crash, that number was 35%. So we're really close to that same level of market concentration in tech.
Wow, that close.
Yeah. And then look at the key companies, the sort of infrastructure providers. It's almost like history repeating itself.
Do you mean comparing the big networking companies back then to the chip makers today?
Precisely. Take a lead-in chip manufacturer right now. Its stock is up something like, 4,300% over the last 5 years?
That's incredible.
It is, but then look back. There was a major networking equipment company, the absolute darling of the dot-com era. In the 5 years leading up to the 2000 peak, its stock surged 4,500%.
Wow. Almost identical trajectories.
Almost identical. The narrative, the investor excitement, the reliance on this one linchpin technology provider. It feels very, very similar.
Okay, that comparison is pretty powerful. But hang on, the sources also point out a key difference, financially speaking, that maybe suggests it isn't the same bubble.
Ah, yes, the valuation metrics. And this is where you need that context. If you look at the PE ratio, the price-to-earnings ratio.
Which tells you how much investors are paying for each dollar of expected earnings, right?
Exactly. For the big tech stocks today, that ratio is sitting around 31 times forward earnings, so what they expect to earn next year. Now, at the absolute height of the dot-com mania, that number was way higher, about 48 times forward earnings.
Okay, so that's a significant difference. On paper, valuations aren't quite as stratospheric as they were in 2000.
Not quite as detached from reality, maybe, but then you look at the human element, the investor sentiment.
The excitement, the buzz.
Yeah. It's definitely hot right now. The sources quote investor surveys showing about 44.5% of individual investors are bullish, optimistic about the market.
Which sounds high.
It is historically high. But compare that to January 2000. Back then, it was 75% bullish, just pure euphoria. So financially, maybe the bubble isn't as inflated, but psychologically, that tension, that excitement bordering on mania, it's definitely present.
So if the headline numbers like PE ratios might be a bit misleading, Where are the real financial risks hiding this time around? Let's pivot from stock prices to the actual mechanics of how this growth is being funded. The sources talk about this idea of an economic money loop.
Yeah, this is crucial. And again, there's a historical parallel. The dot-com era had its own accounting tricks to inflate growth, didn't it?
Right, the classic was that fiber optic bartering.
Yeah.
Remind us quickly how that worked and why it was so problematic.
Okay, so basically, telco companies had laid just vast amounts of fiber optic cable, way more than was actually being used. So company A might have a bunch of unused dark fiber under California, and company B had dark fiber under New York.
Right.
They would essentially trade this capacity. Company A sells its California capacity to B, company B sells its New York capacity to A. Then both companies book billions in revenue on their financial statements from these sales.
Even though no actual new service was being used.
Exactly. No real customers, no actual cash changing hands for services rendered. The cables just sat there, still dark. It was pure paper revenue designed solely to pump up stock prices. Completely artificial.
Okay, that sounds pretty dodgy.
Mm.
The sources argue there's a modern, maybe legal, but similarly questionable version happening now with AI called circular selling. How does that work?
It's this sort of self-reinforcing loop. You have the giant tech companies, the Magnificent Seven types, who desperately want to show massive growth in their AI divisions, right?
Makes sense. That's where the market focus is.
So what do? They invest billions of dollars into promising AI startups, venture capital arms pouring money in. But here's the twist. Those startups need enormous amounts of computing power cloud services, specialized AI chips.
Which they then buy from.
Exactly. They turn right around and spend that investment money buying cloud computing and AI hardware from the very same tech giants who just invested in them, or maybe they're close partners.
Ah, so the money just goes straight back to the big company's cloud or hardware division?
Precisely. It completes the circle. The big tech company gets to report huge AI-related sales figures boosting their stock. The startup gets a massive valuation based on the investment and its spending power. But the underlying cash flow isn't really driven by external customer demand. It's this internal loop.
Can you give that specific example involving the chip makers?
Yeah, look at the big AI chip designers. One major player invests, say, hundreds of millions in a hot AI research lab. But buried in the deal is an agreement that this AI lab will then buy all, or a huge portion, of its specialized AI chips exclusively from that investor.
So the chip makers' sales figures look amazing.
Exactly. Massive sales, booming profits reported to Wall Street. But how much of that is truly organic growth versus this circular flow funded by their own investments? It makes the foundation look potentially less solid than the headline numbers suggest.
And it doesn't stop there, does it? Some companies seem to be using some, let's say, creative accounting methods to handle the massive costs associated with this AI race.
Yeah, aggressive might be the word. It's about managing how those huge expenses hit the books. Take a big social media company, for example. They're buying tens of thousands of these incredibly powerful cutting-edge AI chips. Everyone knows the tech cycles are brutally fast. These chips might be effectively obsolete in, say, 2 or 3 years.
Okay.
But according to the sources, this company is booking these chips on their accounts with a much longer useful life, maybe 5, 7, even 10 years.
Wait, how does pretending a chip lasts 10 years when it's useless in 2 actually help their bottom line now?
It's all about depreciation. When you buy a big asset like that, you spread its cost over its useful life. That annual cost is called depreciation, and it reduces your reported profit. By stretching out that useful life on paper, you make the annual depreciation charge much smaller.
Ah, so it lowers their expenses each year.
Drastically lowers their annual expenses, which artificially inflates their current profits. It makes the company look much more profitable to investors today than it might actually be, effectively hiding the true enormous cost of keeping up in this AI arms race.
Which brings us right to what the sources call the profitability paradox.
Yeah.
All this money flying around, real or maybe circular, huge investments. But is anyone actually making sustainable money from AI services yet?
That is the billion-dollar question, maybe even $1 trillion. And right now, the answer seems to be mostly no. The core business model, especially for generative AI, looks pretty flawed today.
Take the big names, like the leading generative AI firms. Huge valuations. Everyone's heard of them.
Hugely valued, incredibly popular. One prominent example cited has something like 800 million users. Massive reach. But it's projected to lose maybe $9 billion in 2025. And the really critical number, less than 2% of those 800 million users actually pay for the premium subscription.
Less than 2% pay. Wow.
Yeah, so enormous hype and usage doesn't automatically translate into a viable business model. Not yet, anyway.
And that gap between spending and actual revenue seems industry-wide based on the sources.
It's pretty stark when you put the numbers side by side. Estimates suggest annual spending on AI infrastructure chips, data centers, etc., could hit $300 billion in 2025.
Okay, $300 billion in costs. What about revenue from actual AI services in the U.S.?
The estimates there are around $12 billion annually right now.
So spending $300 billion to make $12 billion, that doesn't add up.
Not in the short term, no. The whole gamble is on future potential. To justify that kind of spending trajectory, the sources estimate that AI service revenues would need to soar to something like $2 trillion by 2030.
$2 trillion? Is that realistic?
Well, one study mentioned suggests there's likely to be an $800 billion gap between the revenue needed to justify the spending and what's actually likely to materialize by then. It's a huge bet on future commercialization that hasn't happened yet.
And part of the reason it hasn't happened might be these fundamental technical limits, particularly around the cost of actually running the AI models. Let's clarify this. Inference cost. Every time the AI does something, it costs money.
Exactly. Inference is just the technical term for the AI model actually working, generating text, creating an image, answering a question. Every single time it produces an output, every word or pixel, that requires significant computational power. And that power costs money, electricity, chip time.
So unlike traditional software where maybe I buy a license once and use it a million times.
Right. The marginal cost of using traditional software is basically zero. But with these AI models, especially the big ones, there's a real tangible cost associated with every single use, every thought the AI has. They call it the cost per token.
Which means if I'm a business wanting to use AI for, say, customer service or analyzing millions of documents, that unpredictable, potentially high inference cost could stop me.
It's a major barrier. It makes it really hard to budget for and integrate into core high-volume business processes where costs need to be predictable and low. You can't have your customer service bot costing you dollars every time it answers a simple question.
And that's on top of the fact that the models themselves still aren't perfectly reliable, are they?
No, even the best ones have well-publicized issues. Image generators struggling with basic requests like specific aspect ratios or creating historically absurd pictures. Text generators can still be inconsistent or sometimes overly cautious due to safety filters. This combination of high cost and imperfect reliability, it's a real challenge for widespread adoption, despite the move fast and break things push.
Okay, listening to all that, the circular money, the accounting tricks, the profitability gap, the technical limits, it really does sound like a crash is almost baked in. But we have to give the optimists their due. They argue this time really is different. What's their case?
Their case rests on some pretty fundamental differences from 2000. The first, and maybe the most important, is where the money is coming from.
Right, not just hype and IPOs this time.
Exactly. Back in 2000, a lot of the fuel was, retail investors borrowing money, highly speculative IPOs for companies that were genuinely losing tons of cash with no clear path to profit. Today, the vast majority of the capital flooding into AI is coming from the massive profits and cash reserves of the tech giants themselves, the Magnificent Seven.
So is Microsoft, Google, Amazon, NVIDIA, Meta using their existing fortunes to fund this?
Precisely. These aren't fragile startups built on hope. They're established empires with billions, sometimes trillions in market cap and huge cash flows. That makes the whole system much more resilient to, say, a short-term market dip or a few failed startups. They can absorb losses.
So the idea is the deep pockets of the giants provide a safety net that didn't exist in 2000.
A huge safety net. And for them, this spending isn't just speculative froth. It's seen as a strategic necessity. AI is the next great technological wave, the next continent to conquer, if you like.
So the real risk, in their view, isn't spending too much.
It's not spending enough and falling behind their rivals. Losing the AI race is potentially an existential threat to their dominance. So they see these billions not as waste, but as essential R&D and market positioning.
And the technology itself is more mature this time.
Absolutely. You think back to the early internet dial-up modems, basic websites, very little e-commerce infrastructure. Today's AI, especially these large language models, is already getting deeply woven into existing mature platforms.
Like
Like search engines, office software suites, cloud computing platforms, customer relationship management tools. It's being integrated into the software businesses and consumers already use every day. It's not just a future promise, it's becoming a functional tool right now.
Okay, that makes sense. The other big argument from the optimists you mentioned is this shift away from just building bigger, costlier models towards making them more efficient.
Yes, this is key. The industry realizes the brute force approach, just throwing more data and more chips at the problem, isn't sustainable long term because of those inference costs we talked about. So the new frontier, the new competitive advantage is efficiency, making AI cheaper to run.
And they're making real progress there.
Huge progress. The sources talk about advanced engineering techniques that can slash operational costs by as much as 90% in some cases. It's about getting smarter, not just bigger. They mention three main areas: prompt optimization, quantization, and knowledge distillation.
Okay, break those down quickly for us. What do they actually do?
All right, prompt optimization is the simplest. It just means crafting the instructions you give the AI the prompt to be much shorter and more precise. Less input means less processing, which can cut input costs significantly, maybe 35%.
So better instructions, lower costs. Makes sense. What about quantization?
Quantization is basically model compression. AI models store information as numbers, often very precise, large numbers like 32-bit floating points. Quantization reduces the precision maybe down to 8-bit integers. It's like making the file size smaller.
That makes it faster and cheaper to run.
Exactly. It can mean the model takes up much less memory, maybe fitting 4 times as much on the same chip, and it can run inference 2 or 3 times faster using less power. Big efficiency gains from optimizing the software side.
Okay, optimizing prompts, compressing models. What's the last one? Knowledge distillation.
Knowledge distillation is really clever. You take your huge, incredibly powerful, but very expensive to run teacher model. Then you train a much smaller, simpler, cheaper to run student model. The goal isn't to teach the student everything, but to teach it specifically how the teacher model thinks about certain tasks.
You transfer the intelligence without the massive overhead.
That's the idea. You end up with a lean, efficient student model that can perform a specific task almost as well as the giant teacher model, but at a tiny fraction of the operational cost. This makes deploying AI for specific business applications much more economically viable.
Okay, so putting it all together, we have this potentially shaky financial structure, maybe some aggressive accounting, real questions about near-term profitability.
Right, the bear case.
Versus a technology that's already embedding itself, backed by enormous corporate wealth, and is now rapidly getting more efficient and cheaper to run.
The bull case. Two incredibly compelling but fundamentally opposing narratives.
So where does that leave us? History suggests tech revolutions always have bubbles, right?
Pretty much always, yeah. Railroads, radio, the internet, microchips. They all had periods of intense financial speculation, hype, and then often a painful correction or crash before the real long-term value emerged. So the question isn't really if there will be some kind of financial reckoning for AI, but maybe how it happens.
And the sources lay out a few potential trigger scenarios for a collapse, or at least a very severe correction, things we should maybe watch out for. The first one they call the domino effect.
Yeah, this plays on that circular funding and interdependence we discussed. Think about it. The big tech company invests in the startup pays the tech company for cloud services, the tech company buys chips from the chip maker who might also be invested in the startup. It's all tightly linked.
A house of cards, potentially.
Potentially. If one major piece fails, say a big high-profile AI startup that's burning cash suddenly can't pay its massive cloud computing bills, could that trigger a cascade? Could it expose vulnerabilities in the cloud provider's revenue, spook investors, and cause a chain reaction? It has echoes of the 2008 financial crisis, where the failure of one part exposed systemic risks everywhere.
Okay, that's one possibility. Scenario 2 is the regulatory black swan.
This is about an unforeseen external shock. Imagine a really bad incident involving AI. Maybe a massive security breach where a powerful model is stolen and misused, or, perhaps more plausibly, a sophisticated deepfake video that causes widespread panic or political instability.
Something that forces governments to act drastically.
Exactly. A black swan event that leads to governments worldwide hitting the brakes hard. They might impose an immediate moratorium, a kill switch, on deploying certain types of AI models until stringent safety guarantees are in place, if that happens overnight.
All that expensive, specialized hardware becomes basically worthless.
Instantly obsolete, yeah. A massive write-down across the industry.
And the third scenario is the killer innovation.
This one is about technology itself turning on the current leaders. It's like what happened in the dot-com era when this sudden glut of cheap fiber optic capacity made the old expensive infrastructure investments look foolish.
So what's the equivalent today?
Maybe a sudden, unexpected breakthrough in a completely different technology. Quantum computing suddenly becomes practical and vastly outperforms current AI methods. Or someone designs a radically new, hyper-efficient chip architecture that uses a tenth of the power, making today's massive, power-hungry data centers economically unviable almost overnight. A technological leap that obsoletes the current multi-billion-dollar infrastructure investment.
Three pretty dramatic possibilities. So it really leaves you, the listener, at a crossroads, doesn't it? Do you focus on the financial fragility, the accounting concerns, the current lack of widespread profit, the pessimist view?
Or do you bet on the optimists? Do you believe the sheer scale of strategic investment from the tech giants, combined with this rapid push towards efficiency, will stabilize things and unlock massive long-term value, even if there are bumps along the way?
It's a huge question with enormous implications.
And we genuinely want to know what you think. Based on everything we've unpacked today, what stands out most to you? And which of those scenarios, the domino effect, the regulatory black swan, or the killer innovation, feels like the most plausible trigger for a major correction, if one comes? Please, share your thoughts and any suggestions you have down in the comments. We'd love to read them.
Absolutely. And if you found this deep dive useful, if it gave you some things to think about, please do us a favor, hit the like button, subscribe to the channel if you haven't already. Make sure you click that notification bell so you don't miss our future analyses. And please share this with anyone else you think might find it interesting. Thanks so much for diving deep with us today.